Most people treat this as a simple cost question. Which option is cheaper? But the real decision has nothing to do with interest rates or ownership percentages. Here's the actual lens to use. A bank loan and equity investment cost you completely different assets. A loan takes money from your cash flow every single month on a fixed schedule, regardless of how the business is performing. Miss a payment and you have a legal obligation to resolve. Equity takes none of that, but it does take a permanent slice of everything you build from here on. Every pound of future profit, every increase in company value, every exit. The investor owns part of that indefinitely. So the real question is not which is cheaper on paper, it's what can your business afford to give up? Fixed cash outflows today or a share of future upside forever? Two filters will give you the answer. Filter 1 is cash flow. Can your business reliably cover fixed monthly repayments, even in a slow month? Not an in the best case scenario, but reliably. A retail business with steady, predictable revenue is a good fit for a loan. Repayments are known in advance, ownership stays intact, and the cost ends when the loan is repaid. But if your revenue is lumpy, seasonal, or your early stage, fixed repayments become a real pressure. A loan does not care that December was quiet. The common mistake is borrowing based on optimistic projections rather than your actual floor. If your cash flow can service the debt in a bad month, explore a loan before giving up ownership. If it can't, a loan may create more problems than it solves. And this leads to the second filter. Filter 2 is about what else do you need beyond the capital. A bank gives you money. An equity investor can give you money, networks, credibility, sector expertise, and access to future funding rounds that a lender cannot provide. A tech startup trying to break into enterprise sales is a clear example. The right investor does not just fund the next 12 months, but they open doors that would otherwise take years. In that context, giving up equity is a rational trade. So the honest question is, do you actually need those things, or do you just need some cash? If you need cash and your cash flow passes filter 1, a loan is almost always the better starting point. If you genuinely need more than money, equity may justify the longer-term cost. If both these filters leave you uncertain, that itself is useful information. Your business may not be in a position to take either route responsibly. Here's a rule of thumb. If you have stable cash flow and you just need capital, start with a loan and keep all of your ownership. If you need more than money and can attract the right investor, equity may be worth the trade. If neither fit cleanly, then focus on strengthening your financial position first before committing to either. If that was of value, subscribe to the channel for one real business question answered every video. For the same clarity in writing, the website and newsletter is 5minutebusiness.com.